Inheritance tax, often referred to as IHT, is a tax on the estate of someone who has passed away. This includes everything from property and possessions to money and investments. It's sometimes called death duty, a term that has been used historically. The standard inheritance tax rate is 40%, which can seem quite high. However, it's only charged on the part of your estate that's above a certain threshold, which is an important detail to keep in mind. This threshold is currently £325,000, meaning that any amount below this is not subject to the tax. This means no inheritance tax is due if the value of your estate is below this amount, providing some relief to smaller estates. This applies even if you give your estate away as a gift before you die, under certain conditions. It's important to understand how inheritance tax works, because it can have a significant impact on the amount of money that is passed on to your loved ones. Proper planning can help minimize the tax burden and ensure that more of your estate goes to your family. The nil-rate band is a key part of inheritance tax. This is the amount of your estate that you can pass on tax-free. As we've already said, this is currently £325,000 for individuals. There is an additional allowance called the Residence Nil-Rate Band. This is available when you leave your home to your direct descendants. Direct descendants include children, grandchildren, stepchildren, adopted children, and their spouses or civil partners. This allowance is currently £175,000 per person. This means that a couple could potentially pass on £1 million tax-free. This assumes they are both homeowners and leave their homes to their children. Inheritance tax rules for married couples and civil partners offer valuable exemptions. When one partner dies, their entire estate usually passes to the surviving partner completely free of inheritance tax. This is a significant benefit for married couples and civil partners. Furthermore, any unused portion of the deceased partner's nil-rate band can be transferred to the surviving partner. This can potentially increase the surviving partner's tax-free threshold to £650,000. This transfer can be a valuable tool in estate planning. It's important to seek professional advice to understand how these rules apply to your specific circumstances. Section 4. Gifts and inheritance tax, a balancing act. You can make gifts during your lifetime, and this can be a wonderful way to share your wealth with loved ones. This can be a useful tool for inheritance tax planning, helping to reduce the overall tax burden on your estate. However, there are specific rules and regulations about how these gifts are taxed, which you need to be aware of. Gifts to individuals are generally tax-free as long as you live for 7 years after making the gift, which is known as the 7-year rule. If you die within 7 years, the gift may be subject to inheritance tax, potentially affecting the amount your beneficiaries receive. The amount of tax depends on when the gift was made and its value, with different rates applying at different times. It's important to keep accurate records of all gifts, including dates and values, to ensure clarity. This will help your executors understand your financial history and make the process smoother for them. They can then ensure that your estate is distributed according to your wishes, providing peace of mind for you and your loved ones. Section 5. Navigating the 2024 IHT reforms. Expert advice is key. The year 2024 brought significant changes to inheritance tax, marking a pivotal moment for estate planning. The Labour government introduced several reforms aimed at overhauling the existing system. These changes aim to increase the fairness and effectiveness of the IHT system, ensuring a more equitable distribution of wealth. One key change is a freeze on inheritance tax thresholds until at least 2030, which has significant implications for many families. This means the nil-rate band and Residence Nil-Rate Band will not increase with inflation, potentially affecting estate values. This could potentially drag more estates into the IHT net, increasing the tax burden on families. Another major reform is the inclusion of pensions in the inheritance tax net, a move that has raised many eyebrows. This has significant implications for those with large pension pots, who may now face unexpected tax liabilities. These individuals may need to reconsider their retirement planning strategies to mitigate potential tax impacts. The 2024 reforms also introduce stricter rules for agricultural and business property reliefs, affecting family-owned assets. These reliefs are designed to help families keep these assets within the family, but the new rules make it more challenging. Navigating these changes can be complex and overwhelming for many. Seeking professional advice is paramount to ensure your estate planning remains effective and tax efficient in light of the 2024 reforms. Expert guidance can help you understand the nuances and make informed decisions.